All right, welcome everyone. Today, we're going to break down one of the absolute cornerstones of accounting, IAS 16. We're going to zero in on a really key choice that companies have to make about their biggest assets. And trust me, this choice can dramatically change how you see their financial health.
So, what do a factory, a delivery van, and an office building all have in common? Well, besides being totally essential for business, they're what we accountants call property, plant, and equipment, or PPE for short. These are the long-term workhorses of a company, and there's a very specific rule book for how to treat them.
So here's our game plan for today. We'll kick things off by defining what these assets actually are, figure out how they're valued on day one, and then we get to the critical choice. How do we track their value over time? We'll look at what happens when the value shoots up, what to do when it drops, and wrap it all up with why this choice really matters.
Okay, first things first. Before we can even start talking about valuing something, we need to be crystal clear on what it is we're actually talking about. So let's get the official definition, straight from the standard itself.
Let's break that down into simple terms. There are really three key things here. One, it has to be tangible, something you can physically touch. Two, it's used in the business to make money, not something you're planning to sell tomorrow like your inventory. And three, it's a long-term thing. It's going to be around for more than just 1 year.
So now that we know what PPE is, how do we figure out its value when we first put it on the books? That very first moment we recognize it as an asset. What's the magic number we write down?
The standard is super clear that the cost is way more than just the sticker price. Of course, you've got the purchase price, but you also have to include any cost you can directly link to getting that asset up and running. Think delivery fees, installation costs, and even the estimated cost to eventually take it apart at the end of its life. It's the whole shebang.
All right, so the asset is on our books, we've got its initial cost, now what? Well, from this point on, a company has to make a huge decision on how to measure it over time, and this choice, it's a big deal. It sets the accounting policy for an entire class of assets.
Okay, this is where it gets really interesting. This slide lays out the two roads a company can go down. On one side, you've got the cost model. Think of this as the keep it simple route. It's reliable, you just stick with the history. But on the other side, the revaluation model. This one's all about being relevant right now. It's trying to show you what that asset is worth in today's market. And this, right here, is the classic accounting tug of war. Do you want the certainty of history or the reality and the volatility of today?
So let's really dig into this revaluation model. Imagine our office building suddenly becomes worth a whole lot more than what we have it down for on our books. How in the world do we account for that jump in value?
This right here shows a core principle of accounting, which is prudence. You can't just declare this gain as profit. Why? Because you haven't actually sold the asset. It's just the gain on paper. So instead of hitting your main profit statement, it goes into this special side account called Other Comprehensive Income and gets stored in a part of your equity called the revaluation surplus. Think of it like a holding pen for unrealized gains.
And the standard is super specific about this, and for a very good reason. This gain is seen as unrealized. The company hasn't actually sold the asset to lock in that cash. So it's kept separate from the profits you make from your day-to-day business. It makes the company's net worth look better for sure, but it doesn't boost its reported profit for the year.
Okay, let's flip the coin. What if that same office building's market value suddenly takes a nosedive? This is where the rules get quite a bit different.
And this is the crucial difference. A loss? Boom, it goes straight to the profit or loss statement. It hits your bottom line right away. So while gains are kind of kept off to the side, losses are taken straight on the chin. Now, there is one little exception. If you're just canceling out a previous gain that's already sitting in that revaluation surplus, you use that up first.
So the main takeaway here is this asymmetry. Accounting treats gains and losses very differently. Gains are parked in equity until they're realized, but losses, they hit the income statement immediately. It's another perfect example of that principle of prudence at work.
So you might be wondering, why have two different models at all? Why does this choice between the simple cost model and the more complicated revaluation model actually matter to someone who's just trying to read a company's financial report?
Well, this choice has some serious real-world consequences. The revaluation model gives you a more up-to-date, relevant picture of what an asset's worth, but it can also make a company's balance sheet jump all over the place. It also makes it pretty tricky to compare two companies in the same industry if one uses cost and the other uses revaluation. And that revaluation surplus we talked about, it's not cash, so you can't pay out dividends from it. And that's really the big question this whole standard leaves us with.
As an investor, what would you rather see? The stable, predictable historical view of the cost model, or the relevant but potentially wild ride of the revaluation model? There's no single right answer. And honestly, that's what makes digging into these financial statements so fascinating. Thanks so much for watching.